We had a very good first quarter of 2025. The Kenya Shilling Fund returned 4.89% for Q1. That's about 19.56% annualized, which is much better than what we actually returned in the Q4 of 2024, a return of 3.78. The dollar fund did just as well, returning 3.14 for Q1 this year. That's a 12.56% annualized return. Again, this is better than what we did last year, with the return being 2.97% last year. So we're very pleased by this return, especially because I know for most of our investors, due to the volatility that we experienced in Q1, we know that a lot of our investors did not actually expect us to do much better than we did last year. So this is a return that we are very happy to announce. Q1 was a very interesting quarter. One of the most interesting quarters we've had, I think, even since COVID, in terms of volatility, in terms of unforeseen policy changes, and then just market reactions to a lot of these changes. Of course, we started the year with very stable markets. We had a very positive outlook. But the first thing that actually threw off the markets was a change in the artificial intelligence market space with the entrance of a new participant called DeepSeek that made investors question the valuation of a lot of Western AI programs, because DeepSeek came in with the ability to do the same thing as the other programs, but at a much cheaper rate. Of course, DeepSeek is a Chinese program. So that sent the valuations for some of the AI companies much lower, and the tech companies that support them. So Q1 of 2025 started moderately poorly for tech companies. The other thing was now just the government changes with the Trump administration and their focus on increasing efficiency. So they created the Department of Government Efficiency, what is referred to as DOGE. And one of the things that this has had an impact on markets is creating concerns about, is there going to be a reduction in employment? Because obviously, more efficiency for government means also less employment because, of course, you have to cut jobs. And the impact that this has on government spending, so those concerns also led to a bit of volatility in the markets. So Q1 was very volatile because of this. Then now towards the end of the quarter, we now had the tariff wars, which now President Trump created. The first ones being creating tariffs on Canada and Mexico, just sort of like the first tariffs we saw. And this actually led to markets losing value. So from the beginning of the year to around mid-February, markets were actually up about 4%. And then towards the end of the March, they dropped off about 10% to actually close in the negative territory. So we're talking about a market that was up, then down. So that volatility was very interesting to see. Of course, it impacted volatility in terms of an index by itself. The volatility index was up almost 30%. And then, of course, another asset class that is a very big indicator of flight to safety, gold, was up almost 20% for Q1 of this year. So it was very interesting to trade in Q1. But it's very important for me to emphasize that this is why Mansa-X is such a good investment. It's really the only place you can actually invest that you get the ability to be long, short, and be able to actually take advantage of volatile markets as they have been in Q1 to still make a return. As you can see, in spite of this volatility, Mansa-X was still able to give a return better than it did in Q4 of last year. And this is in spite or actually because also of the volatility that we experience. So volatility for us in Mansa-X is not a bad thing. In fact, sometimes we welcome it because we're able to get more opportunities in some asset classes, and we're able to take advantage to give an even better return for our investors. Obviously, when you have a lot of policy changes like this, it also affects the Fed's ability to create monetary policy. Because on one hand, you have tariffs increasing inflation, then on the other hand, you have employment concerns due to changes in government policy on spending and so on. So we'll be watching very closely how the Fed reacts to all this moving forward, as this will also greatly impact markets. But in summary, Q1 was very interesting, and again, we are very happy that we came out on top, and we will be looking forward to an even more interesting Q2. So, so we can go now to have a look at our top 10 holdings, and just to advise our investors, these top 10 holdings are clearly outlined in our fact sheet. We publish a fact sheet every quarter, and we'd advise our investors to be having a look at this because it gives them an idea of the overall picture of the fund. And on top of that, we also publish a global markets outlook, essentially a fund manager's report, again every quarter, that goes into even more detail, giving you an understanding of how the fund was able to make the return that it made in that quarter, what investments were made and the rationale behind those investments, and then also giving you some forward guidance, so you have an idea of what we as your fund managers are looking to do in the next quarter. So we'd advise our investors to be taking some time to go through those documents. If you haven't received them on email, please reach out to your financial advisors who will be able to share them with you. And then when you look at our top 10 holdings, it's important to note that top 10 holdings really refers to the proportion of those assets in the fund. We don't mean that the top 10 holdings refers to the ones that performed the best or the top 10 performing asset classes. No, we mean that the proportion of those asset classes were the highest, were the top 10 highest within the fund. So it's a factor of proportion to the fund when we refer to the top 10 holdings. So let's go into that now. So the top 10 holding was fixed income instruments. Fixed income instruments refers essentially to government securities. We are talking about mostly African Eurobonds, U.S. Treasuries, German bonds, and sometimes also some local government securities. That was the largest asset class. Not much of a movement there, but it helps to manage stability of returns for the fund, and it tends to be coupled with interest rate derivatives. The reason we use interest rate derivatives is to primarily hedge our interest rate risk created by being in those fixed income instruments. So you'll notice that the two of them tend to go hand in hand. The other asset class that was very critical for us in Q1 was actually the volatility index. Like I mentioned earlier, volatility in Q1 jumped 30%. Like I mentioned before, volatility is actually an asset class you can actually invest in. This allows you to actually benefit from higher volatility in markets. Again, this was a very good asset class for us to hold. We essentially long volatility, meaning we were expecting volatility to be higher and therefore bet on higher volatility figures. The Canadian dollar is an asset class we've been holding even from the previous quarter, but not much of a change this quarter. The other thing that we went into was the iShares MSCI for China. One of the things we noticed in Q1 was the tariff wars and the changes in policy have sort of created an investor sentiment where investor funds are now looking for a new home outside Americas to prevent oversaturation there. So we've seen funds going into China and also Europe. We were not left behind, and we were actually long the China ETF. And this is actually an ETF that was up 16%. So you can see that's on a quarter-on-quarter basis, that's a very good return in terms of how an ETF performs. We had a bit of cash there, not much to say there. Then Best Buy is an electronics chain. So we were actually expecting that share price to fall because with the tariffs war, of course, one of the things that have been affected are electronics. So we were short there, and we were actually correct in that Best Buy lost about 14% in Q1 alone. BAE Systems, again, like I mentioned, we have a lot of, from a global perspective, Europe and China are actually trying to be a bit more autonomous. So one of the things that has happened in Europe is now they have increased their defense budget to essentially stop over-reliance on the US. And because of that, BAE Systems, one of the biggest defense contractors in Europe, was up over 35%. This is a stock that we were actually long in Q1. United Parcel Services, delivery company, we were short this stock, and it actually lost about 12%. This is really just the fact that, when you have a lot more expensive items and so on, you expect less deliveries because people are buying essentially less and less. So UPS was one of our short stocks in the Kenya Shilling Fund. Gilead Sciences, for healthcare stocks, we've actually seen that during very volatile environments like the ones we've seen in Q1, they tend to also be very good defensive stocks, meaning that they're just good stocks to hold because they tend to perform well and they're not too volatile. And Gilead Sciences, for example, was up 21.3%. We were long this stock. The healthcare sector was actually the second best performing sector in Q1 of this year. So from a geographical distribution, we were still mostly in American companies, with the Americas part of our portfolio being about 40% of our portfolio, but we were also very significantly in Europe at 33%. The rest now were Africa, Middle East and Asia, and the Oceania region. But moving forward, we expect that maybe for Asia, we'll see a much larger allocation in the next quarters as we see what kind of policy shifts we'll be seeing globally. For the dollar fund, the top 10 holdings are largely the same. The only difference would be for crude oil, which we were holding. The movement quarter on, year to, for the quarter doesn't seem like it was much, but we saw a lot of volatility in the crude oil as an asset class. So we actually took advantage of volatility there and was actually one of our best returning commodities for the dollar fund. Then we also had asset classes like 5 below, where we were actually short. The CME group, we were actually long that one, and Siemens, which we were actually long. So if you look at our book, one of the things you'll notice that's a bit different this quarter was compared to 2024, where most of our top 10 positions were mostly just long-only positions. You now see in Q1 of this year that we had a lot of long positions, but also a lot of short positions. This is exactly what we keep saying, that Mansa-X is a long-short strategy fund, meaning that when volatility rears its head like it did in Q1, you then see a lot of short positions starting to show up in your top 10 holdings. And I'd say for majority of the book, we had a lot of other short positions. Another thing you might notice is a lot of our tech stocks fell off the top 10 holdings, essentially meaning we really cut back on a lot of those, mostly because, like I mentioned earlier, one of the first sectors to take a hit from the AI issue and the tariffs was actually tech companies. So we saw the likes of Tesla, Amazon, Apple, and NVIDIA actually lose value in Q1. Again, that's why you see we really cut back on this. So this also explains to investors the active management of the fund. You can see how quickly we are able to reposition asset classes based on the new dynamics that are happening in markets. And this is how we are able to not only give you a better return, but also to sort of create stability in terms of whether you make a return quarter on quarter in spite of shifting market dynamics. Again, for the geographical distribution, for the dollar fund, very similar to the Kenya Shilling one. You have Americas as one of the largest areas, and then Europe, Africa, Middle East, and Oceania followed after that. So very similar to the Kenya Shilling Fund. We still expect that moving forward for Q2 and most likely for the rest of the year, trade and fiscal policy developments will remain very critical factors in shaping investor sentiment. So everything we'll do will really be based around this. And we believe that most investors around the world will also be following these policy developments very keenly. But one of the things we expect is also that countries will actually come to negotiate with the US on tariffs, and because obviously it has also affected them negatively. So we expect that they'll negotiate with the US, and we believe that this is a positive development, will end up being a positive development for the markets. Another thing that's giving us a lot more confidence moving forward is that we saw, the US President Donald Trump actually backtracking on interfering with the Fed in terms of, calling for the Fed chairman to be removed. So these are some of the things that we expect will also help markets because now we are seeing a lot more restraint from the administration, probably because they are seeing the effects of the tariff wars on the markets. We'll also be looking very much at commodities. We have seen that in environments such as this, the commodity markets tend to be very good non-correlated assets with the stock market. So we'll be looking at the likes of gold, oil, copper, to see how they can use this to also further diversify the book even better. So this is one of the things that we expect will help the return for investors in Q2. Currencies now also become a very big deal. We expect a lot more currency trading moving forward, mostly because, again, we are seeing a lot of dollar weakness across the globe now, with a lot of currencies now actually performing better than the dollar. So we'll be also taking advantage of such movements, because there's almost like a shift in the global investor sentiment to now sell America, being now like almost like it's actually now an objective for most investors now to sell America. So we'll be looking at how we can also participate in that. Again, we'll be looking at how the likes of Germany and how they actually do things like economic stimulus. We saw in Q1, Germany announcing a 500 billion euro stimulus package that was really big and very unprecedented, and was really supposed to push industrialization and defense. Again, this is why we'll be continuously looking at defense stocks, especially in Europe. Moving forward, Fed policy, again, something we'll be looking at. This year, we started the year expecting only 2 cuts this year, but right after Liberation Day, when Trump announced the new tariffs, the market was really spooked, and in fact, they were expecting 7 rate cuts at that point this year. But now we are down to 3, but that's still 1 rate cut more than was expected at the beginning of the year. Again, the stocks we'll be in, we'll be looking to increase our holdings in defensive stocks, so healthcare stocks, consumer staples, utilities, and financials. Again, this is something that we expect will keep the fund on an even keel, and we expect the returns to remain stabilized as a result. Locally, we think that inflation remains at a good level, at around 4.1%. That's well within the CBK range. And we saw the CBK in Q1 cut rates from 10.75 to 10. We still expect rates to keep coming off in the local environment. And we feel that the Kenyan economy right now is quite resilient, very good forex reserves. In fact, our reserves at one of the highest levels we have seen in the recent past, and we expect this to continue. So we expect the shilling to continue being one of the best performing currencies in the world, actually, against the dollar. The Kenyan local stock market did very well, up almost 6% in Q1 for most of the major stocks, and we expect this to continue into Q2. Again, we expect a resilient Kenyan economy. One of the things that quite surprised us was the large diaspora remittances that we saw in Q4 last year compared to 2023. We saw a remittance of $4.94 billion last year compared to $4.1 billion the previous year. But again, this is something we'll be watching very closely because of the impact that tariffs might have, or what's happening in the US markets and how that might impact our diaspora community, and whether they can continue remitting the kind of funds that they did last year. Again, Q1 was also interesting to see that the Kenyan GDP actually overtook Ethiopia, again showing the resilience of the Kenyan economy. So moving forward for Q2, again, just policy developments and trade policy, that's something we'll be watching very keenly to allow us to decide what to do within the fund. But again, we are very proactive in this fund, and we constantly do portfolio management in such a way that we protect the downside for our investors if need be, and we always constantly try to protect investors' capital from being harmed by the changes in the market dynamics. And we'll continue doing this moving forward. So we'd really like to thank our investors once again for believing in our product, for believing in Mansa-X. The fund has continued to grow. We are now in our seventh year of operations, and the fund has grown to assets under management of about 55 billion now, compared to actually 46 billion at the close of last year, a 20% increase. So we are very thankful to our investors who continue to invest in us, new and existing, because also a big part of our growth is actually just existing clients who keep topping up. That's something we really appreciate. And also the new investors who learn about our product and invest with us. We are now managing funds for over 33,000 investors. And we want to emphasize and reiterate that no matter how big the fund grows, we continue to seek opportunities that will keep the return even better than it has been. Our promise to investors has always been a commitment to giving an above average return. And this is something that we'll continue to endeavor to do, but at the same time, being very, very careful about managing the risk of the fund. And no matter the volatility you see in markets, we want to remind our investors not to worry. There's a reason you pay us a management fee, and let us do the worrying for you. We will manage the volatility and endeavor to give you a return that will typically beat what the rest of the market is offering. For our Mombasa investors, again, just to remind them that we have a Mombasa office now that is fully functional, and they can always receive services there. We have a very good team of financial advisors there they can always have access to. So again, this is part of our strategy to make sure that we serve our investors better. Just to remind investors, and I believe you've all received your notifications, we will have our first AGM the 16th of May, and it's actually the first AGM that has been held by a special CIS like Mansa-X in our capital markets. This is also part of our strategy to make sure that there's absolute transparency in how we manage our client funds, and to make sure that we get as much feedback as we can from our investors, both existing and potential, so that we can create moving forward an even better product for you. So once again, just to thank you very much, and to confirm our commitment to manage your funds even better moving forward.